Welcome to the Finance Wisdom Summaries.
The Simple Path to Wealth, your roadmap to financial independence and a rich, free life. Introduction. The Simple Path to Wealth by J.L. Collins, with a foreword by Mr. Money Mustache, serves as a practical guide to achieving financial independence and living a rich, free life. The book originated from a series of letters the author wrote to his daughter, aiming to demystify money and investing. Collins emphasizes that understanding money is crucial because it can be a powerful servant if mastered, or a master if neglected. He argues that complex investments primarily benefit those who create and sell them, being both more costly and less effective for the investor. Key guidelines: spend less than you earn, invest the surplus, and avoid debt. Avoiding debt is as undesirable as being covered in leeches with similar negative effects. A lifestyle that matches or exceeds income leads to financial enslavement. Avoid fiscally irresponsible individuals in personal and financial relationships. Be wary of investment advisors, as many prioritize their own interests. By the time you can identify a good one, you'll likely be capable of managing your finances independently. Your money is best cared for by you. Possessions can metaphorically own you. Money's most valuable purchase is freedom. Always be aware of the financial impact of your life choices. Sound investing is not complicated. Save and invest a portion of every dollar earned. A higher savings rate accelerates the accumulation of FU money. Saving and investing 50% of income is achievable without debt. A high savings rate teaches living on less while increasing investment capital. The stock market is a powerful wealth-building tool, and market drops are normal and should be seen as buying opportunities. Ignoring panic and media hysteria during market downturns will be challenging, but crucial. Financial independence is achieved when you can live on 4% of your investments annually. Daily application. Track your spending. Understand where every dollar goes to identify areas where you can reduce expenses and increase your surplus for investment. Use a simple spreadsheet or budgeting app. Prioritize debt repayment. If you have high-interest debt, make a plan to aggressively pay it off. This frees up significant cash flow for investing. Automate savings. Set up automatic transfers from your checking account to your investment account each payday. This ensures you consistently pay yourself first. Question consumerism. Before making a purchase, consider if it's a true need or a want influenced by marketing. Reflect on the opportunity cost of that money.
Chapter 2. A Parable, the Monk and the Minister. This short parable illustrates a core principle of financial independence. Happiness and freedom are not solely dependent on high income, but also on managing your needs and desires. The rich minister, despite his wealth, remains catering to the king due to his high expenses, while the humble monk finds freedom by learning to live simply. Daily application. Evaluate your must-haves versus nice-to-haves. Reflect on your spending and identify areas where you might be catering to the king, unnecessary expenses that keep you tied to work. Practice mindful consumption. Before buying something, ask yourself if it genuinely adds value to your life or if it's simply fulfilling a perceived need driven by external pressures. Experiment with frugality. Try a no-spend day or week to discover how much you can truly live without and what brings you genuine satisfaction.
Chapter 3. My story, it has never been about retirement. Collins shares his personal journey to financial independence, highlighting that for him, it was never about traditional retirement, but about gaining options and the freedom to say no, what he calls FU money. He emphasizes that financial independence is as much about living modestly as it is about accumulating wealth. His first taste of FU money, a modest $5,000 at age 25, gave him the leverage to negotiate a sabbatical for travel. This experience taught him the power of financial freedom to influence life choices. He also recounts a period where both he and his wife were not working, yet their net worth continued to grow, marking their true financial independence. He attributes their success to a consistent 50% savings rate, avoiding debt, and embracing low-cost index funds. Key takeaways. Financial independence provides the freedom to make choices aligned with your values, rather than being dictated by the need for a paycheck. A high savings rate is crucial for rapid wealth accumulation. Avoiding debt liberates your income for investment. Embracing simple, low-cost index funds is key to long-term success. Market downturns can be opportunities, especially when you are accumulating wealth. Daily application. Calculate your current savings rate. This is a powerful metric to track your progress toward financial independence. Aim to increase it over time. Identify your FU money goal. Define what level of financial freedom means to you. Is it the ability to take a sabbatical, change careers, or something else? Having a concrete goal makes saving more tangible. Automate investing. Set up recurring investments into your chosen index fund. This removes emotion from the process and ensures consistent contributions. Chapter 4. Important Notes. This chapter serves as a disclaimer and explanation for the methodology used in the book's examples and projections. Collins notes that laws, regulations, and specific financial numbers are subject to change, but the broader concepts remain valid. He explains that what-if scenarios are for illustrative purposes only and not predictions of future returns. He clarifies the parameters used for his calculations, such as dividend reinvestment and ignoring inflation and fees, and emphasizes that readers can adjust these to their own situations. He explicitly states that the 11.9% average annual market return used in some examples is historical and not a guarantee of future returns. Key takeaways. Financial information is dynamic. Always verify current laws, regulations, and specific financial numbers for your situation. Projections are illustrative and not guarantees. Understanding the assumptions behind financial models is crucial. The core principles of investing for the long term remain valid despite market fluctuations. Daily application. Cross-reference financial information. If you encounter specific numbers or rules, especially regarding taxes or investment limits, double-check them with current sources. Focus on principles over predictions. While it's natural to look at historical returns, concentrate on understanding and applying the fundamental investing principles rather than getting fixated on specific predicted returns. Use online calculators. Experiment with the suggested calculators, inputting your own data and various assumptions to gain a personalized understanding of different scenarios.
Main chapters. Chapter 1. Debt, the unacceptable burden. Collins strongly advocates for avoiding debt, describing it as the single most dangerous obstacle to building wealth. He recounts his early misunderstanding of credit card minimum payments and his sister's clarification of the crippling interest rates. He argues that debt is often promoted as normal, but leads to financial enslavement and diminished lifestyles due to interest payments. He details the negative emotional and psychological effects of debt, including stress, shame, and helplessness. He provides a guideline for paying off existing debt. Prioritize debts with interest rates over 5% immediately, and consider paying off those between 3 and 5% or investing the money based on comfort level. He advises against debt consolidation services and focusing on small loans first for psychological boosts, instead urging a direct, disciplined approach to eliminating debt by cutting non-essential spending. Finally, he cautions against good debt, like mortgages and student loans, highlighting how easily available financing can lead to overspending and long-term financial burdens. Key takeaways. Debt is a destroyer of wealth and financial freedom. High-interest debt should be eliminated aggressively. Cutting non-essential spending is key to freeing up money for debt repayment and later investment. Good debt can still lead to overspending and long-term financial constraints. Daily application. Audit your subscriptions and recurring expenses. Identify any non-essential services you can cancel to free up cash. Cook at home. Significantly reduce dining out and takeout to reallocate that money towards debt repayment or investments. Delay gratification. Before making a significant purchase, practice waiting a week or a month. Often the desire for the item will diminish and you'll avoid unnecessary debt. Finally, review student loan interest rates. If you have student loans, understand their interest rates and consider accelerating payments if they are high.
Chapter 2. Why you need FU money. Collins emphasizes that FU money is the most valuable thing money can buy: freedom. He shares his personal experience of being laid off after 9/11 and how his accumulated FU money provided security and options during 3 years of unemployment. He reiterates that living paycheck to paycheck or carrying debt equates to financial enslavement. The concept allows you to walk away from undesirable situations, negotiate better terms, and pursue opportunities without financial constraints. Key takeaways. FU money grants freedom and options, not just wealth. It protects against unexpected job loss or financial setbacks. It provides the power to negotiate and make choices aligned with your desires. Daily application. Set a target for your FU money. This could be 3 to 6 months of living expenses in an easily accessible account, or a larger sum that allows for career changes or extended time off. Visualize the freedom. Regularly remind yourself why you are saving FU money. This motivation can help you stay disciplined in your spending and saving habits. Review your negotiation power. Consider how having FU money could impact your current work situation or future career moves. Chapter 3. Can everyone really retire a millionaire? Collins provocatively answers yes, that it is possible for every middle-class wage earner to retire a millionaire, although he notes it will likely never happen due to human behavior. He uses historical S&P 500 returns, 11.9% annually from 1975 to 2015, with dividends reinvested, to demonstrate how even small monthly investments can compound to over $1 million in 40 years. He stresses that compounding takes time, so starting young is beneficial. The chapter highlights that financial independence is equally about limiting needs as it is about accumulating money. He presents a simple formula: spend less than you earn, invest the surplus, avoid debt. Through a case study, he shows how a person earning $25,000 annually could become financially independent with $312,500 by living on $12,500 and investing the rest, reaching their goal in about 11.5 years. He cautions against the pervasive marketing forces that promote endless consumption, obscuring the path to financial freedom. Key takeaways. Compounding is a powerful force that can turn modest investments into significant wealth over time. Financial independence is a function of both income and controlled spending. The spend less than you earn, invest the surplus, avoid debt formula is fundamental. Resisting societal pressures to consume is crucial for financial freedom. Daily application. Calculate your financial independence number. Determine how much money you need invested to cover your annual expenses at a 4% withdrawal rate. This provides a clear target. Find financial independence role models. Seek out blogs, podcasts, or communities of people who are achieving financial independence on modest incomes. Their strategies and mindsets can be inspiring. Differentiate needs from wants. Before every purchase, pause and categorize it. This helps train your mind to resist unnecessary spending. Chapter 4. How to think about money. This chapter delves into different levels of thinking about money, moving beyond just spending. Collins encourages readers to consider a $100 bill not just for what it can buy immediately, but for its earning potential through investment. He introduces the concept of opportunity cost, explaining that when you spend money, you not only lose that money, but also all the potential earnings it could have generated through investment. He emphasizes that this lost earning potential, compounded over time, can be substantial. Collins uses Warren Buffett's rule number 1, never lose money, to illustrate that this doesn't mean avoiding market drops, but rather understanding that investments represent ownership in businesses that grow over time, making short-term fluctuations inconsequential. He argues that owning a broad-based index fund like VTSAX means owning a piece of thousands of companies that are constantly striving to succeed and replacing failing ones, creating a powerful upward bias over time. Key takeaways: shift your mindset from money as a spending tool to money as an earning tool. Understand and account for the opportunity cost of every spending decision. View market volatility as normal fluctuations in the value of underlying businesses rather than permanent losses. The market's long-term upward trend is driven by the inherent dynamism of businesses striving for success. Daily application. Practice mental accounting for purchases. Before buying something, quickly estimate how much that money could earn if invested over 5, 10, or 20 years. This helps you internalize opportunity cost. Invest regularly, regardless of market conditions. Instead of trying to time the market, commit to consistent investments. This aligns with the long-term business ownership mindset. Educate yourself on market fundamentals. Read about how businesses grow and contribute to economic expansion to reinforce the belief in the long-term upward trend of the stock market.
Chapter 5. Investing in a raging bull or bear market. This chapter addresses the common fear of investing during market highs or lows. Collins asserts that it's impossible to time the market. He outlines his core investing principles. The market is the most powerful wealth-building tool. It always goes up over the long term, and investors must mentally toughen up to ride out volatility. He acknowledges that fear is natural, but warns that it prevents investment and leads to panic selling during downturns. He emphasizes that crashes, corrections, and pullbacks are normal and expected parts of the market's relentless rise. Collins uses historical examples of Dow Jones Industrial Average growth over decades to demonstrate the market's long-term upward trend despite turmoil. He concludes that the key question is not when to invest, but whether to invest at all, stressing the importance of accepting volatility as the price for long-term rewards. Key takeaways. Market timing is an impossible and unprofitable endeavor. Fear and greed are detrimental emotions for investors. Market crashes and corrections are normal and temporary parts of the market. Long-term investing in the stock market consistently yields the best returns. Mental toughness is crucial to endure market volatility and avoid panic selling. Daily application. Ignore market news. Avoid daily financial news and predictions, as they often fuel fear and irrational decisions. Focus on your long-term plan. Automate investments regardless of market conditions. Continue investing consistently, whether the market is up or down. View dips as opportunities to buy more shares at a lower price. Remind yourself of market history. Periodically review long-term market charts to reinforce the understanding that the market always recovers and grows over time.
Chapter 6. There's a major market crash coming, and even famous economists can't save you. Collins continues his critique of market complexity and the idea that experts can predict or prevent financial crises. He challenges the adaptive markets hypothesis, which suggests buy and hold investing doesn't work anymore due to increased volatility, arguing that the flaw lies in human behavior, not the strategy. He dismisses the common advice of broad asset allocation across many investment types as a canard that leads to subpar performance. Instead, he advocates for toughening up and curing bad investment behavior, recognizing that market crashes are to be expected, but the market always recovers. He uses historical events like the 1974-75 recession, the 1987 crash, and 9/11 to illustrate the market's resilience. Collins concludes that a major market crash is inevitable, but it represents a wonderful buying opportunity for those prepared to ride it out. Key takeaways. Complexity in investing is often a marketing ploy. Diversifying across countless asset classes is generally unnecessary and less effective than a simple approach. Emotional discipline, toughening up, is more critical than trying to predict market movements. Market downturns are a normal and recurring part of the investment cycle, offering opportunities for long-term investors. Daily application. Develop an investment policy statement, IPS. This personal document outlines your investment goals, risk tolerance, and strategy. Refer to it during market downturns to avoid emotional decisions. Automate investments regardless of market sentiment. Continue your regular contributions even when the news is negative. This allows you to consistently buy more shares during dips. Educate yourself on market history. Knowing that crashes are a normal part of the cycle helps build the mental fortitude to endure them.
Chapter 7. The Market Always Goes Up. This chapter reiterates the fundamental principle that the stock market, over time, always goes up despite its inherent volatility. Collins shares his own painful experience during the 1987 Black Monday crash, where his fear led him to sell at the bottom only to buy back in higher later. This mistake, though expensive, taught him the invaluable lesson of mental toughness. He explains that the market's upward bias is due to two main reasons. It is self-cleansing, failing companies are replaced by new, thriving ones within the index, and it represents ownership in dynamic businesses striving for success. He highlights Vanguard's Total Stock Market Index Fund, VTSAX, as the ideal tool to access this relentless growth, as it encompasses virtually every publicly traded U.S. company. Key takeaways. The long-term trend of the stock market is relentlessly upward. Personal experience can be a powerful, albeit expensive, teacher of investment discipline. The self-cleansing nature of broad market indexes contributes to their long-term growth. Owning an index fund means owning a piece of dynamic, striving businesses, not just abstract slips of paper. Daily application. Visualize the long-term trend. When tempted to check daily market fluctuations, remind yourself of the historical charts that showed the relentless upward movement over decades. Focus on owning businesses, not just stocks. Consider that your VTSAX shares represent a tiny ownership in thousands of companies that are actively working to grow and innovate. Review your investment goals periodically. Reconfirming your long-term goals can help you stay committed to your strategy during short-term market turbulence.
Chapter 8. Why most people lose money in the market. Collins asserts that despite the stock market's wealth-building potential, most people lose money due to psychological pitfalls. He identifies three main reasons. 1. Market timing. Humans are hardwired to buy high and sell low, panicking during downturns and buying during soaring markets. This leads to worse returns than the funds themselves generate. 2. Stock picking. The belief that one can pick individual winning stocks is a fool's errand, as even the vast majority of professionals fail to consistently beat the market. Occasional wins are seductive, but don't build wealth reliably. 3. Mutual fund manager picking. Actively managed mutual funds rarely outperform their benchmarks over the long term. Only 18% survived and outperformed an index over 15 years in one Vanguard study, and less than 1% in a 30-year study, yet charge high fees. Fund companies use tricks like selective time frames and burying underperforming funds to mislead investors. 4. Focusing on the foam. Collins likens the stock market to a mug of beer, where the beer is the underlying operating businesses and the foam is the daily price fluctuations and media hype. Most investors focus on the foam, volatility, predictions, which is useless and dangerous, rather than the beer, the long-term growth of businesses. Key takeaways. Human psychology is inherently unsuited for successful active investing. Attempting to pick individual stocks or outperforming fund managers is generally futile and costly. High fees on actively managed funds are a significant drag on returns. Ignore short-term market noise and focus on the fundamental value of owning businesses for the long term. Daily application. Resist the urge to check your portfolio frequently. Daily checking of stock prices feeds the FOMO mentality. Focus on quarterly or annual reviews. Educate yourself on behavioral economics. Understanding common cognitive biases can help you recognize and avoid irrational investment decisions. Choose broad-based, low-cost index funds. This simplifies your investing and removes the temptation to pick individual winners. Automate dividend reinvestment. This ensures that the beer portion of your investment automatically compounds without you having to make manual decisions.
Chapter 9. The Big Ugly Event. This chapter specifically addresses the fear of a major market crash, using the Great Depression, 1929, as the big ugly event. While acknowledging the devastating 90% loss during that period and the 26 years it took for a full recovery for those who invested at the peak, Collins argues that such an event is extremely rare and survivable within a long-term strategy. He points out that most investors would not have borne the full weight of the crash, and for those just starting their careers, a crash is ironically a gift, allowing them to buy stocks at bargain prices. He also discusses hyperinflation as another major wealth-destroying event, but notes that stocks tend to be a good hedge against inflation as business assets and products rise in value. The core message is that while big ugly events are scary, they are rare and survivable if you stick to the simple path of spending less, investing the surplus, and avoiding debt. Key takeaways. Major market crashes or big ugly events are extremely rare but can be devastating. For young investors, a market crash is an opportunity to buy assets at a discount. Stocks can provide a hedge against inflation, while bonds hedge against deflation. The long-term, simple path to wealth is survivable even through major economic downturns. Daily application. Maintain an emergency fund. This is your buffer against needing to sell investments during a market downturn for unforeseen expenses. Practice emotional detachment from market news. When headlines scream about impending crashes, remind yourself of the long-term perspective. Consider your investment horizon. For young investors with decades to go, market crashes are less of a threat and more of an opportunity.
Chapter 10. Keeping it simple. Considerations and tools. This chapter introduces the core tools for implementing the simple path to wealth. 3 considerations and 3 investment tools. The 3 considerations. Investment stage. Are you in the wealth accumulation stage, working in saving, or wealth preservation stage, living off investments, or a blend? 2. Risk tolerance. What level of market volatility can you comfortably endure? 3. Investment horizon. Is your investment timeline long-term or short-term? Collins emphasizes that safety is an illusion and all investments carry risk, but you get to choose the type. He argues that age doesn't strictly define your stage and that FU money is critical for flexibility. He also challenges the conventional wisdom of reducing stock exposure significantly with age, advocating for a long-term perspective even in retirement. The 3 tools. For stocks, VTSAX, Vanguard Total Stock Market Index Fund, for wealth building and inflation hedging. 2 bonds, VBTLX, Vanguard Total Bond Market Index Fund, for income, smoothing stock volatility, and deflation hedging. And 3 cash, for routine expenses and emergencies, and as a hedge against deflation, though its value erodes with inflation. He recommends keeping minimal cash and explains his preference for bank accounts over money market funds in a low interest rate environment. Key takeaways. Simplicity in investing leads to better results and saves time. No investment is risk-free. Choose the type of risk you are comfortable with. Your investment stage is fluid and not solely tied to age. The core investment tools are a total stock market index fund, a total bond market index fund, and cash. Daily application. Define your current investment stage. Are you primarily accumulating, preserving, or blending? This helps guide your asset allocation. Assess your true risk tolerance. Be honest about how you would react to a significant market downturn. This helps determine your stock-bond allocation.
Optimize your cash holdings. Keep enough cash for immediate needs and emergencies, but avoid holding excessive amounts that lose purchasing power to inflation.
Chapter 11. Index funds are really just for lazy people, right? Collins directly refutes the notion that index investing is for lazy people, stating it's for those who want the best possible results. He praises Jack Bogle, founder of Vanguard, for democratizing investing and consistently demonstrating that broad market index funds outperform professional management over time, especially when considering costs. He explains that indexing fundamentally challenges the high-fee Wall Street model. Collins admits his own past hang-up of believing he could outperform the market, a pursuit he now deems a fool's errand that cost him years and money. He argues that accepting market average returns is actually a top-tier strategy, as the index outperforms 82% to 99% of actively managed funds over long periods. He highlights the devastating drag of high expense ratios on wealth accumulation, contrasting Vanguard's 0.05% with the industry average of 1.25%. Finally, he attributes resistance to indexing to intellectual hubris, the desire for quick results and bragging rights, and the relentless marketing from an industry that profits from complexity. Key takeaways. Index investing is a superior strategy for optimal long-term returns. Outperforming the market consistently is exceptionally difficult, even for professionals. High fees significantly erode investment returns over time. Resist the allure of excitement and bragging rights in investing. Focus on consistent, profitable simplicity. Daily application. Check expense ratios. Review your current investments and understand their expense ratios. If they are high, over 0.15 to 0.20%, consider switching to lower-cost index funds. Avoid investment products that promise to beat the market. These often come with high fees and rarely deliver on their promises. Embrace the average mindset. Understand that being average in index investing means being in the top tier of performance.
Chapter 12. Bonds. This chapter explains the role of bonds in a diversified portfolio. Bonds serve as a deflation hedge and help smooth out the volatility of stocks while also providing income. Collins explains that when you buy a bond, you are essentially loaning money to a company or government agency. He elaborates on various bond risks, including default risk, the issuer failing to pay back the loan, interest rate risk, bond value changes inversely with interest rates when sold before maturity, and inflation risk, the value of money repaid decreases during inflation. He emphasizes that investing in a broad-based bond index fund, like Vanguard's Total Bond Index Fund, VBTLX, mitigates these individual bond risks due to its diversification across thousands of high-quality bonds with varying maturity dates. He briefly touches on municipal bonds as tax-exempt options for those in higher tax brackets. Key takeaways. Bonds provide portfolio diversification, reduce volatility, and act as a hedge against deflation. Individual bond risks, default, interest rate, and inflation are significantly reduced by investing in a broad-based bond index fund. Vanguard's VBTLX is the recommended bond fund due to its low cost and diversification. Daily application. Understand your risk tolerance for bonds. If you are highly risk-averse, a larger bond allocation might be suitable. If you prioritize growth and can tolerate more volatility, a smaller allocation is fine. Consider your investment horizon for bonds. If you are nearing retirement or in the wealth preservation stage, bonds become more important for stability. Choose a total bond market index fund. Avoid trying to pick individual bonds, as a diversified fund handles the complexities and risks more effectively.
Chapter 13. Portfolio Ideas to Build and Keep Your Wealth. This chapter outlines two simple portfolio strategies using the previously discussed funds. 1. The Wealth Accumulation Portfolio for young, aggressive investors. This portfolio consists of 100% VKSAX, Vanguard Total Stock Market Index Fund. Collins argues that for those with decades of investing ahead, stocks are the best performing asset class, and market downturns are, quote, stocks on sale opportunities, end quote. He emphasizes mental toughness to ride out volatility. The Wealth Preservation Portfolio for those nearing or in retirement. This portfolio is a blend of approximately 75% VTSAX and 20% VBTLX, Vanguard Total Bond Market Index Fund, with 5% in cash. The bonds help smooth volatility and provide income, while the cash covers expenses and offers a deflation hedge. He notes that this allocation can be fine-tuned based on personal comfort with volatility and desired growth. He acknowledges that some studies show a slight outperformance for a small bond allocation, 10 to 25%, even in the accumulation phase, but still favors 100% stocks for simplicity in that stage. Key takeaways. A 100% stock allocation, VTSAX, is ideal for wealth accumulation due to its highest long-term returns and, quote, self-cleansing nature. For wealth preservation, a mix of stocks, VTSAX, and bonds, VBTLX, offers a smoother ride with less volatility, albeit potentially lower long-term returns. Cash is essential for liquidity and emergencies in both stages. Portfolio adjustment is a personal choice based on risk tolerance and stage of life. Daily application. Implement your chosen portfolio. Select either the wealth accumulation or the wealth preservation portfolio, or a variation, and begin investing in the recommended funds. Automate your contributions. Set up regular automatic investments into your chosen funds or funds to maintain discipline. Resist the urge to tinker. Once your allocation is set, avoid frequent changes based on market fluctuations. Trust the long-term strategy.
Chapter 14, Selecting Your Asset Allocation. This chapter delves deeper into balancing your investment portfolio based on temperament, goals, effort willingness, and risk tolerance. Collins reiterates the two main stages: wealth accumulation, favoring 100% VTSAX, especially with a high savings rate that smooths out volatility, and wealth preservation, adding bonds for stability. He discusses the concept of effort, noting that while adding a small percentage of bonds, 10 to 25%, might slightly outperform 100% stocks, the difference is often negligible and adds complexity due to the need for rebalancing. If rebalancing is a concern, target retirement funds, TRFs, are presented as a simpler alternative that automatically adjust allocations over time, though with slightly higher fees. He also emphasizes various risk factors beyond just market volatility, such as personal temperament, flexibility in lifestyle and income, and the percentage of assets needed to cover expenses. The chapter addresses when to shift into bonds, suggesting a gradual transition 5 to 10 years before retirement for a smoother ride, or staying in stocks longer if more risk tolerant. Key takeaways. Asset allocation is a personal decision driven by individual factors. Simplicity, 100% stocks for accumulation, is generally preferred unless minimal additional effort for slight potential gain is desired. Rebalancing, if chosen, should be done annually or after significant market moves, ideally in tax-advantaged accounts. Target retirement funds offer a set-it-and-forget-it solution for asset allocation and rebalancing. Risk tolerance is influenced by temperament, lifestyle flexibility, and reliance on investment income. Daily application. Determine your asset allocation. Based on your current stage, risk tolerance, and effort willingness, decide on your stock bond cash percentages. Set a rebalancing schedule, if applicable. If you choose a multi-fund portfolio, set a reminder for annual rebalancing. Practice lifestyle flexibility. Cultivate the ability to adjust your spending if needed, which can increase your comfort with investment risk.
Chapter 15, International Funds. Collins explains why his simple path typically excludes dedicated international funds, despite their common recommendation by other advisors. He outlines three main reasons for this exclusion. 1. Added risk.
International funds introduce currency risk, fluctuations between foreign currencies and the US dollar, and accounting risk, less transparent standards in some countries. 2. Added expense. Even low-cost Vanguard international funds have expense ratios at least double that of VTSAX, a direct drag on returns. 3. Already covered. The majority of the 500 largest U.S. companies in VTSAX, which make up 80% of the fund, are multinational businesses, generating significant sales and profits overseas. This provides ample international exposure without the added risks and expenses of dedicated international funds. He also argues that as world economies become more interconnected, the diversification benefit of international funds due to uncorrelated performance is diminishing. For those who still desire more international exposure, he suggests Vanguard's FTSE All-World ex-US Index Fund, VFWAX, or Total International Stock Index Fund, VTIAX, or the Total World Stock Index Fund, VTWSX, if wanting a single global fund. Key takeaways. Dedicated international funds introduce additional currency and accounting risks. They typically have higher expense ratios than U.S. total stock market index funds. U.S. total stock market index funds like VTSAX already provide significant international exposure through their multinational holdings. The correlation between global markets is increasing, reducing the diversification benefit of separate international funds. Daily application. Understand your existing exposure. If you hold VTSAX, recognize that you already have exposure to international markets through the multinational companies within the fund. Prioritize low costs. If you choose to add an international fund, select one with the lowest possible expense ratio. Keep it simple. Unless you have a strong, well-researched reason, sticking to a U.S. total stock market index fund for your equity exposure aligns with the simple path.
Chapter 16, TRFs, the simplest path to wealth of all. For those seeking the utmost simplicity, Collins introduces target retirement funds, or TRFs, as the simplest path to wealth of all. These funds of funds automatically adjust their asset allocation to become more conservative as the target retirement date approaches, requiring no active management from the investor. Vanguard's TRFs hold 4 core index funds: Total Stock Market, Total Bond Market, Total International Stock Market, and Total International Bond Market. While their expense ratios are slightly higher than individual index funds, 0.14 to 0.16% compared to VTSAX, 0.05%, they offer significant convenience. Collins notes that while he prefers individual funds for lower fees and tax optimization, TRFs are an excellent choice for many, especially if offered in employer-sponsored retirement plans like 401ks. Key takeaways. Target retirement funds offer a one-decision investment solution that automatically rebalances over time. They are funds of funds, investing in a diversified portfolio of underlying index funds. TRFs generally have higher expense ratios than individual index funds, but offer unparalleled simplicity. They are a particularly good option for employer-sponsored retirement plans. Daily application. Check your employer's retirement plan options. If TRFs are offered, investigate their expense ratios and underlying holdings to see if they align with a simple, low-cost strategy. Choose a TRF based on your desired risk level. If you want a more aggressive allocation, select a TRF with a later target date. For more conservative, an earlier date. Automate contributions to your TRF. Set it and forget it, knowing your portfolio is professionally managed and rebalanced.
Chapter 17. What if you can't buy VTSAX or even Vanguard? This chapter provides alternatives for investors who cannot access Vanguard's specific Admiral Shares funds, VTSAX and VBTLX, perhaps due to the $10,000 minimum investment or employer plan limitations. Collins explains that Vanguard offers different classes of the same portfolios, such as Investor Shares, VTSMX, with a lower minimum, $3,000, and slightly higher expense ratio of 0.17%, or ETFs, VTI, with a 0.05% expense ratio but potential trading commissions. He emphasizes that the core objective is to buy the Vanguard Total Stock Market Index portfolio, regardless of the fund class. For those whose employer plans don't offer Vanguard, he advises seeking out low-cost total stock or S&P 500 index funds from other reputable mutual fund companies, or exploring TRFs if the fees are reasonable. For international readers, he suggests global funds like VTWSX, Vanguard Total World Stock Index Fund, or its ETF counterpart, VT, cautioning to ensure the fund includes the U.S. market. The bottom line is to prioritize low-cost, broad-based index funds, and if Vanguard isn't an option, to find the closest equivalent. Key takeaways. The portfolio, Total Stock Market Index or Total Bond Market Index, is more important than the specific Vanguard fund class. Alternatives to VTSAX include Vanguard's Investor Shares, VTSMX, or ETF, VTI. If Vanguard is unavailable, seek out low-cost total stock or S&P 500 index funds from other reputable companies. International investors should look for global index funds that include the U.S. market. Daily application. Review your employer's 401k or retirement plan. Identify the lowest cost index fund options available, even if they aren't Vanguard. Compare fund options. If you have access to different fund classes, example, Admiral versus Investor Shares, choose the one that best suits your investment amount and fee sensitivity. Research alternatives. If Vanguard is not accessible, use online tools to find comparable low-cost index funds from other providers in your country.
Chapter 18. What is it about Vanguard anyway? This chapter explains Colin's strong preference for Vanguard, emphasizing its unique client-owned and at-cost structure. Unlike other investment companies that serve both their owners or shareholders and their fund investors, Vanguard's investors are its owners. This alignment of interests means Vanguard operates with the goal of charging only the minimum fees needed to cover operational costs, resulting in significantly lower expense ratios. Average of 0.18% at Vanguard versus 1.01% industry average. Collins clarifies that investing in Vanguard funds means investing in the underlying stocks and bonds, so Vanguard's implosion would not affect the underlying assets. He assures readers that Vanguard funds are held as separate entities with their own fraud insurance and oversight, and that Vanguard is regulated by the SEC, providing security. He also directly addresses potential disasters like a physical attack or cyber attack, noting Vanguard's comprehensive disaster recovery plan. Finally, he explicitly states that he receives no compensation from Vanguard for his recommendations. Key takeaways. Vanguard's unique client-owned structure aligns it directly with its investors, leading to lower fees. Lower expense ratios at Vanguard translate into significantly higher returns for investors over time. Investing in Vanguard funds is investing in the underlying stocks and bonds, so Vanguard's implosion would not affect the underlying assets. Vanguard has robust security measures and disaster recovery plans. Daily application. Prioritize low-cost providers. When choosing an investment company, look for those with a proven track record of low fees, like Vanguard. Understand the ownership structure. Recognize that companies with a fiduciary duty to shareholders may have conflicts of interest with their investors. Don't fear a single point of failure. Understand that your investments are typically held separately from the investment company, providing a layer of protection.
Chapter 19. The 401k, 403b, TSP, IRA, and Roth buckets. This chapter explains the different buckets, account types, for holding your investments, emphasizing that 401ks, IRAs, etc. are not investments themselves, but vehicles to hold them. The discussion becomes U.S.-centric, categorizing buckets as ordinary, taxable, and tax-advantaged, tax-deferred, or tax-free. He advises placing tax-inefficient investments like bonds, VBTLX, and REITs in tax-advantaged accounts due to their interest and frequent taxable distributions, while tax-efficient investments like VTSAX, with its modest qualified dividends and rare capital gains distributions, can be held in ordinary buckets. He stresses that tax-advantaged accounts only defer, not eliminate tax obligations, with withdrawals generally taxed and penalized before age 59.5, and required minimum distributions, RMDs, beginning at 70.5, except for Roth IRAs. He details employer-based plans, 401k, 403b, TSP, and individual IRAs, deductible, non-deductible, and Roth, outlining their contribution caps, tax treatment, and withdrawal rules. Key recommendations include maxing out employer match contributions, free money, and rolling over employer plans into personal IRAs upon leaving a job to gain more control and avoid high fees. He highlights Roth IRAs as particularly attractive for tax-free growth and withdrawals, but notes the after-tax contribution as a key consideration and potential long-term risks if tax laws change. Collins provides a hierarchy for deploying investment money, prioritizing employer matches, Roth IRAs for low-income earners, deductible IRAs for higher earners, and taxable accounts for any remaining funds. Key takeaways. Understand the difference between investment buckets, account types, and investments, the funds within them. Optimize tax efficiency by holding tax-inefficient investments, like bonds, in tax-advantaged accounts, and tax-efficient investments, like VTSAX, in ordinary buckets. Max out employer contributions to retirement plans. Roll over employer plans into IRAs when leaving a job for greater control and lower fees. Roth IRAs offer significant tax benefits, especially if current income taxes are low, but consider the after-tax contribution and potential future tax law changes. Collins provides a hierarchy for deploying investment money, prioritizing employer matches, Roth IRAs for low-income earners, deductible IRAs for higher earners, and taxable accounts for any remaining funds. Daily application. Know your account types. Understand which of your investment accounts are tax-advantaged, example 401k IRA, and which are taxable. Prioritize contributions. Follow the suggested hierarchy for funding your accounts each year. Monitor RMD rules. Be aware of the RMD rules for your tax-deferred accounts as you approach age 70.5 and plan for tax-efficient withdrawals. Consider Roth conversions. If you expect to be in a lower tax bracket in retirement, explore the possibility of a Roth conversion ladder as linked in the chapter.
Chapter 20. RMDs, the ugly surprise at the end of the tax-deferred rainbow. This chapter addresses required minimum distributions, RMDs, the mandatory withdrawals from most tax-advantaged retirement accounts, except Roth IRAs, that begin at age 70.5. Collins emphasizes that these are not optional, and failing to take the full distribution results in a hefty 50% penalty. He warns that for those who have diligently maxed out their tax-deferred accounts, these RMDs can be substantial and potentially push them into higher tax brackets. He uses an example to illustrate how RMDs can grow significantly over time. Collins suggests a strategy to mitigate the impact of RMDs. If your tax bracket drops in retirement between your retirement age and 70.5, consider converting money from traditional IRAs to Roth IRAs, paying taxes at the lower current rate to avoid higher future taxes from RMDs. Key takeaways. RMDs are mandatory withdrawals from tax-deferred accounts starting at age 70.5 with severe penalties for non-compliance. Large tax-deferred balances can lead to higher tax brackets due to RMDs. Strategic Roth conversions during lower income years in retirement can minimize future tax burdens from RMDs. Daily application. Plan for RMDs in advance. As you approach age 70.5, use online RMD calculators to project your future withdrawals and their potential tax impact. Consider Roth conversions strategically. If your income is low in retirement, look for opportunities to convert portions of your traditional IRA to a Roth IRA, staying within lower tax brackets. Understand tax implications of different withdrawal strategies. Consult with a tax professional if your situation is complex.
Chapter 21, HSAs, more than just a way to pay your medical bills. This chapter highlights health savings accounts as a powerful, often overlooked investment tool in the U.S. healthcare landscape. HSAs are available to those with high-deductible health insurance plans and offer a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Crucially, unlike flexible spending accounts or FSAs, HSA funds roll over year to year and remain yours until used. Collins emphasizes that while HSAs can be used for current medical bills, their real power lies in investing the funds and allowing them to grow tax-free for future medical expenses, especially in retirement. Funds can also be withdrawn for non-medical reasons after age 65 or if permanently disabled, subject only to income tax, effectively functioning like an IRA. Key takeaways: HSAs offer a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. HSA funds do not expire and can be invested for long-term growth. After age 65, HSA funds can be withdrawn for any reason, taxed only as ordinary income, acting as a valuable retirement account. Daily application: investigate HSA eligibility. If you have a high-deductible health plan, determine if you are eligible for an HSA. Max out your HSA contributions. Prioritize contributing the maximum allowed to your HSA, viewing it as a powerful long-term investment vehicle. Invest your HSA funds. Choose low-cost index funds within your HSA to maximize tax-free growth. Pay current medical expenses out of pocket if possible. This allows your HSA funds to continue growing tax-free for as long as possible.
Chapter 22, Case Study, Putting the Simple Path to Wealth into Action. This chapter presents a real-life case study of a reader from Collins' blog, illustrating how to apply the simple path to wealth principles to an existing financial situation. The reader, with some initial seed capital and an existing 403(b) and mutual funds, is guided on how to consolidate investments, advised to move existing mutual funds into VTSAX, Admiral shares when possible, investor shares, or ETF as a start. Optimize tax-advantaged accounts, maximize 403(b) contributions, especially to capture employer match, and fully fund a Roth IRA. Prioritize savings rate. Encourage to save significantly more than initially planned to accelerate financial independence. Understand dollar cost averaging. Briefly touches on the concept, implying it's a natural outcome of investing as money is earned rather than a strategy for large lump sums. The example demonstrates the power of compounding on initial capital and consistent contributions, highlighting how a 24% savings rate can lead to multi-million-dollar wealth over decades. Collins reinforces that achieving financial independence is a matter of choice and priorities, focusing on living within one's means to free up capital for investment. Key takeaways: it's never too late to implement the simple path, even with existing complex financial arrangements. Consolidating investments into low-cost index funds is a practical first step. Maximizing contributions to tax-advantaged accounts and maintaining a high savings rate accelerates wealth building. Financial independence is primarily a function of controlling needs and consistently investing the surplus. Daily application: review your existing portfolio. Identify any high-fee mutual funds or individual stocks that could be consolidated into low-cost index funds. Increase your savings rate. Look for ways to boost the percentage of your income that you save and invest, even by small amounts initially. Create a visual tracker. Use a spreadsheet or app to track your net worth and savings rate, making your progress tangible.
Chapter 23, Why I Don't Like Investment Advisors. Collins expresses a strong dislike for most investment advisors, arguing that the industry often makes investing seem complex to profit from clients' intimidation. He states that advisors are expensive at best and will rob you at worst, citing Bernie Madoff as an extreme example. He identifies three main ways advisors earn money and how each works against the client. Commissions, or loads. Advisors are paid each time an investment is bought or sold, creating a conflict of interest where they might recommend high commission products. Say a 5.75% load on a $10,000 investment means $575 goes to the advisor, not your investment. Assets under management, AUM model, charging an annual fee, typically 1 to 2% on total client assets. This is presented as more objective, but is a huge drag on wealth growth, as it skims the absolute cream of returns. He demonstrates that a 2% annual fee can reduce a $100,000 investment's growth over 20 years by hundreds of thousands of dollars. Hourly fees, while the most straightforward, hourly rates can be high, $200 to $300 plus per hour, and still don't guarantee good advice. Collins argues that since most actively managed funds often recommended by advisors fail to outperform index funds, their value proposition is fundamentally flawed. He advises extreme caution and never relinquishing control of your money, as no one will care for it better than you. Key takeaways. Investment advisors often create complexity to justify their fees. Common advisor compensation models, commissions, and AUM fees significantly erode investor returns. Most actively managed funds, commonly recommended by advisors, fail to outperform index funds. Personal control over your finances is paramount, as no one will prioritize your money more than you. Daily application. Be skeptical of free financial advice. Understand that advisors are compensated, and their compensation structure can influence their recommendations. Calculate advisor fees. If you have an advisor, understand exactly how they are paid and calculate the total percentage of your assets that goes towards fees annually. Self-educate on investing. The more you understand simple investing principles, the less susceptible you will be to complex, high-fee products.
Chapter 24, Jack Bogle and the Bashing of Index Funds. Collins begins this section by confessing his own past stubborn rejection of indexing, admitting he made all the arguments against it for too long. He reiterates his admiration for Jack Bogle, who he credits with creating the low-cost index fund and exposing the financial industry's self-serving practices. He cites Warren Buffett's recommendation for a simple 90% S&P 500 index fund, 10% government bonds portfolio, as further evidence of indexing's superiority. Collins attributes the continued bashing of indexing to human greed, psychology, and the vast sums of money involved in the actively managed fund industry. He points out the absurdity that there are more actively managed stock mutual funds, around 4,600, than publicly traded U.S. companies, around 3,700, indicating that many are simply churning money for fees rather than delivering value. Key takeaways. Indexing is a proven superior investment strategy, even if it's counterintuitive to smart people. The financial industry actively promotes complex, high-fee products to protect its profitability, often at the expense of investors. Warren Buffett's endorsement of index funds further validates their effectiveness. Understanding the motivations of those who bash indexing, that is, protecting their income stream, helps investors stay on track. Daily application. Challenge conventional wisdom. Be critical of financial advice that seems overly complex or promises extraordinary returns. Follow the money. Consider who benefits from a particular investment product or strategy. If it involves high fees, it's likely not in your best interest. Rely on the data. Rely on long-term studies and the recommendations of financially independent individuals, rather than industry marketing. Chapter 25, Why I Can't Pick Winning Stocks, and You Can't Either. Collins humorously admits his own past hubris in believing he could pick winning stocks, sharing a personal anecdote of a short-lived win that reinforced his addiction to the idea. He asserts that the ability to consistently pick winning stocks is extraordinarily difficult, expensive, and a fool's errand, even for most professionals. He uses the example of corporate forecasting to illustrate the inherent difficulty of predicting the future, even within a company, let alone the broader market. He points out that the few who do appear to consistently outperform, like Warren Buffett, are rare exceptions, and academic research even questions if it's skill or just luck. The core message is humility. Accepting that you cannot reliably pick winners will save you time, effort, and money, leading you to embrace the proven strategy of indexing. Key takeaways. Consistent stock picking is almost impossible task for individual investors and most professionals. Short-term wins are seductive, but do not equate to long-term wealth building. The future is inherently unpredictable, even for corporations planning their own growth. Humility and recognizing your limitations are essential for successful investing. Daily application.
Avoid individual stock speculation. Resist the urge to buy individual stocks based on tips, news, or personal hunches. Stick to diversified index funds. Don't chase past performance. Understand that a stock's or fund's past performance is not indicative of future results. Channel your competitive energy elsewhere. If you enjoy the game of investing, focus your efforts on increasing your savings rate or learning about personal finance rather than trying to beat the market.
Chapter 26. Why I Don't Like Dollar Cost Averaging. Collins expresses his skepticism about dollar cost averaging for lump sums, arguing that while it aims to mitigate pain during market downturns, it often results in spared gain because the market is statistically more likely to rise. DCA involves investing a large sum slowly over time, example, monthly installments, but Collins contends this is essentially a form of market timing, a loser's game he advises against. He also points out that DCA skews your asset allocation by keeping a significant portion of your capital in cash on the sidelines, potentially for extended periods, thus missing out on market growth. He concludes that for lump sums, investing the entire amount immediately, lump sum investing, is generally the more effective strategy due to the market's long-term upward bias. Key takeaways. Dollar cost averaging for lump sums is often a form of market timing, which is generally ineffective. The market is more likely to rise than fall, meaning DCA often leads to spared gain. DCA can keep a significant portion of your investment capital out of the market, hindering long-term growth. For a lump sum, immediate investment is usually the more profitable approach due to the market's long-term upward bias. Daily application. Invest lump sums promptly. If you receive a large sum of money, example, bonus inheritance, consider investing it all at once rather than dollar cost averaging. Understand the trade-offs. Be aware that while lump sum investing carries short-term volatility risk, it generally offers better long-term returns. Focus on continuous investment. For regular income, continue to invest consistently as you earn, which is a natural form of dollar cost averaging without the lump sum implications.
Chapter 28. You too can be conned. This chapter serves as a stark warning about various forms of financial cons, from outright scams to subtle deceptions by legitimate professionals. Collins shares a personal anecdote about helping a widowed friend avoid being conned out of her inheritance, highlighting her vulnerability to schemes despite her intelligence. He describes a classic stock-picking con, where an initial series of correct predictions, sent to different groups of people, ensuring some receive winning advice by chance, leads to an invitation to a high-pressure, expensive sales pitch. He stresses that clever scammers target the smart, the rich, and the lonely, exploiting psychological weaknesses rather than outright stupidity. The chapter ends with a strong recommendation for couples to openly discuss their financial situation and investment strategy to protect against manipulation. Key takeaways. Financial cons can be sophisticated and target intelligent individuals. Be wary of unsolicited, too-good-to-be-true investment opportunities. High-pressure sales tactics and promises of guaranteed high returns are red flags. Open communication and shared understanding of finances within a household are crucial for protection. Daily application. Maintain healthy skepticism. Question any financial advice that sounds too good to be true or promises unrealistic returns. Never rush financial decisions. Take your time, do your research, and consult trusted sources before committing to any investment. Educate loved ones. Discuss financial topics with family members, especially those who may be vulnerable to scams, to equip them with knowledge and awareness. Check advisor credentials. If considering an advisor, verify their background and any disciplinary actions through regulatory bodies.
Chapter 29. Withdrawal rates. How much can I spend anyway? This chapter focuses on the 4% rule, a commonly cited guideline for sustainable retirement withdrawals. Based on the Trinity study, 1998,
This rule suggests that withdrawing 4% of your initial portfolio value, adjusted annually for inflation, provides a high probability, 96%, for a 50-50 stock bond portfolio over 30 years, of your money lasting throughout retirement. Collins notes that while the study's results are robust, the financial media often simplifies it, and recent market events, example the 2008 crash, highlight the need for flexibility. He emphasizes the critical role of stocks in preserving and growing wealth over time, even during withdrawals, and reiterates the devastating impact of high fees on portfolio longevity. A 1% fee can significantly reduce success rates. Ultimately, the 4% rule is a guide, and sensible flexibility in spending provides true security. Key takeaways. The 4% rule is a guideline for sustainable withdrawal rates in retirement, offering a high probability of portfolio longevity. Stocks are crucial for long-term wealth preservation and growth even during withdrawals. High investment fees severely diminish portfolio success rates. Flexibility in spending is important to adapt to market conditions in retirement. Daily application. Estimate your annual expenses in retirement. This forms the basis for calculating your target portfolio size using the 4% rule, 25 times annual expenses. Track your current spending diligently. Knowing your actual expenses helps you project your retirement needs more accurately. Build a diversified portfolio. Ensure your portfolio has a healthy allocation to stocks to support long-term growth, even during withdrawals. Review your withdrawal strategy periodically. As market conditions change, be prepared to adjust your spending slightly to ensure portfolio longevity.
Chapter 30. How do I pull my 4%? This chapter provides practical guidance on how to withdraw funds from your portfolio once you are financially independent and your assets are covering your bills. Collins assumes the ideal scenario of having rolled employer-based plans into an IRA, with investments split between VTSAX and VBTLX in tax-advantaged and ordinary taxable accounts. He shares his personal withdrawal approach. 1. Prioritize cash from dividends and bond interest. These payments are directed to checking accounts for immediate spending. 2. Sell funds from taxable accounts first. This allows tax-advantaged accounts to continue growing tax-deferred for as long as possible. 3. Strategically convert traditional IRA to Roth IRA. For those within 10 years of age 70 and half, he recommends converting as much as possible from traditional IRAs to Roth IRAs, aiming to stay within the 15% tax bracket to minimize future RMD tax burdens. 4. Rely on RMDs at 70 and half. Once RMDs begin, these withdrawals will replace those from the taxable account, allowing the taxable account to grow again. He emphasizes that this approach is flexible rather than rigid, and they track expenses with a spreadsheet to adjust spending if needed during market downturns. He cautions against setting up a rigid 4% withdrawal plan and forgetting about it, stressing the importance of sensible flexibility to ensure portfolio survival. Key takeaways. Strategically withdraw from different account types to optimize tax efficiency. Prioritize leaving tax-advantaged accounts untouched for as long as possible. Utilize the period between retirement and age 70 and a half for Roth conversions to manage future RMD tax liabilities. Maintain a flexible spending approach in retirement, adjusting as market conditions or personal needs change. Daily application. Familiarize yourself with withdrawal order. Understand the tax implications of withdrawing from different accounts: taxable, traditional IRA, Roth IRA. Track your expenses regularly. This helps you understand your burn rate and adjust if necessary. Simulate Roth conversions. If you're nearing retirement, consider running scenarios to see how strategic Roth conversions could impact your future tax burden.
Chapter 31. Social Security. How secure and when to take it. Collins shares his personal evolution on Social Security, moving from skepticism to valuing it as a sweet deal. He explains the common concerns about the solvency of Social Security, for instance, the trust fund being held in U.S. Treasury bonds, implying it's not real money. But he clarifies that these bonds represent money owed to ourselves and are backed by the full faith and credit of the U.S. government. He addresses the projected shortfall, noting that after 2033, payroll taxes are expected to cover about 75% of scheduled benefits, implying a potential reduction rather than a complete collapse. The chapter also discusses when to start collecting Social Security. While benefits can begin at age 62, they are permanently reduced. Delaying benefits until full retirement age, or FRA, or even age 70 results in significantly higher monthly payments. Collins outlines his personal strategy. His wife will start at her FRA, while he will delay until age 70 to maximize his benefit, which his wife can then switch to if he predeceases her, given women's longer life expectancy. He emphasizes that a reliable government check in advanced age, when mental acuity may diminish, has value beyond just the dollars. While some choose to take benefits early due to skepticism about the system's future, Collins believes Congress will tinker to ensure its survival. He concludes that while fiscally responsible individuals might have done better investing their contributions themselves, Social Security serves as a vital safety net for the majority who might otherwise struggle. Key takeaways. Social Security, while facing projected shortfalls, is likely to remain a significant source of income for retirees. Delaying Social Security benefits until age 70 can significantly increase monthly payouts. Consider spousal benefits and life expectancy when deciding when to claim benefits. Social Security provides an invaluable safety net for many, even if it's not the most optimized return for fiscally disciplined individuals. Daily application. Access your Social Security statement. Review your earnings history and estimated benefits on the Social Security Administration website. Run what-if scenarios for claiming age. Use online calculators to see how different claiming ages impact your monthly benefit. Coordinate with your spouse. Discuss a joint strategy for claiming benefits that maximizes your household's long-term income, considering life expectancies.
Chapter 32, How to Give Like a Billionaire. This chapter focuses on charitable giving, sharing Collins's personal experience of setting up the JL Charitable Fund through the Vanguard Charitable Endowment Program. He explains that this allows them to give like a billionaire by donating appreciated assets, such as stocks, instead of cash, gaining an immediate tax deduction while the money continues to grow tax-free within the foundation before being distributed to charities later. This strategy provides flexibility and tax advantages, especially for those who may not itemize deductions annually or anticipate being in a lower tax bracket in retirement. He offers practical advice for charitable giving. Give larger donations less frequently. This maximizes impact and reduces administrative overhead. Avoid phone solicitors and charities with excessive advertising. These often have lower efficiency. Do your homework. Vet charities using resources like Charity Navigator to ensure your money is used effectively. Consider direct giving. Helping friends and neighbors directly is not tax deductible, but has immediate tangible benefits. Key takeaways. Charitable foundations like those offered by Vanguard allow for tax-efficient giving, especially with appreciated assets. Giving appreciated assets can provide immediate tax deductions while allowing the donated funds to grow tax-free before distribution. Strategic giving can be tailored to individual tax situations and long-term philanthropic goals. Be discerning when choosing charities, prioritizing efficiency and direct impact. Daily application. Track your charitable giving. Keep records of your donations for tax purposes. Explore donor-advised funds. If you have appreciated assets and a desire for charitable giving, research donor-advised funds like Vanguard's to understand their benefits. Vet charities before donating. Use online resources to research the efficiency and impact of organizations you support.
Chapter 33, My Path for My Kid, The First 10 Years. This chapter outlines Collins' actionable 10-year plan for his daughter, which also serves as a guide for anyone looking to build wealth. The core tenets are: avoid debt and fiscally irresponsible people. Debt is a major impediment to wealth. Focus on career building and professional reputation. This period is for developing skills and increasing earning potential. Maintain low living expenses, resist lifestyle inflation, and use low-cost college living skills. Save and invest at least 50% of income in VTSAX. This aggressive savings rate in a broad-based index fund is the engine of wealth accumulation. He predicts that within 10 to 15 years, two things will happen: a career surge and nearing financial independence. Financial independence is defined as having 25 times annual expenses invested, meaning you can live on 4% of your assets. The chapter reiterates that controlling needs is as important as building assets. Once financially independent, the choice arises to continue working and invest 100% of earnings or pursue new ventures. He also advises delaying major purchases like houses until they are easily affordable and align with desired lifestyle changes, as houses are expensive indulgences, not investments. The overall message is that this path leads to expanding opportunities and freedom. Key takeaways. A high savings rate, example 50%, combined with career growth is a powerful wealth-building accelerator. Financial independence is achieved when invested assets equal 25 times annual expenses. Controlling living expenses and avoiding lifestyle inflation are crucial for reaching financial independence sooner. Major purchases like homes should be carefully considered and made from a position of financial strength. Daily application. Calculate your years to financial independence. Use online calculators that factor in your savings rate and desired annual expenses. Regularly review your spending to identify lifestyle creep. Consciously resist increasing your expenses as your income rises. Focus on skill development. Invest in yourself and your career to increase your earning potential.
Chapter 34, Tales from the South Pacific. This chapter offers an inspirational anecdote about a couple who quit their jobs to move to Tahiti, initially struggling with a pineapple plantation, but ultimately finding success by taking a bold, opportunistic risk to finish a half-built hotel. Collins highlights Mosk and his friends as great examples of living boldly and embracing life on their own terms, breaking free from debt, consumerism, and limiting mindsets. The story serves to reinforce that financial freedom provides the single most valuable thing money can buy: the ability to explore the world and live life on your own terms, free from constraints. Key takeaways. Financial freedom opens up a world of possibilities for living life on your own terms. Boldness and seizing opportunities can lead to unexpected paths to success. Breaking free from debt and consumerism is essential for true freedom. Daily application. Dream big, but plan practically. Use your financial independence journey to envision a life of greater freedom and choice. Be open to unexpected opportunities. Once financially secure, you have the flexibility to pursue ventures that might have seemed too risky before. Reflect on your definition of a rich life. It's not just about money, but about having the time and freedom to pursue what truly matters to you. Chapter 35. Some final thoughts on risk. In the concluding chapter, Collins reiterates that pursuing financial freedom necessitates taking on investment risk, but frames it not as deprivation, but as buying FU money and endless possibilities. He re-emphasizes the core premise that the stock market always goes up over the long term, using the Dow's century-long climb through various disasters as evidence for this perspective. He clarifies the distinction between risk and volatility. Stocks have high volatility but high wealth-building potential, while cash has low volatility but its purchasing power is eroded by inflation over time. The key is to understand your needs, psychology, and goals when deciding on your risk tolerance. He concludes that fear often leads to missed opportunities, and that overcoming personal fears is crucial for weathering financial storms and achieving success. Key takeaways. Investing for financial freedom inherently involves taking on risk, which is a trade-off for greater returns. The long-term trend of the stock market is upward, making short-term volatility a necessary part of the journey. Cash, while seeming safe, is a guaranteed loser over the long term due to inflation.
Understanding and managing your fear is paramount to successful investing and avoiding detrimental emotional decisions. Daily application. Periodically review your risk tolerance. As your net worth grows and your goals evolve, your comfort with risk may change. Educate yourself on the long-term impact of inflation. Understand how it erodes purchasing power, motivating you to invest rather than hoard cash. Celebrate small wins. Acknowledge your progress in building FU money to reinforce positive financial habits and reduce fear.
Main idea of the book. The Simple Path to Wealth argues that achieving financial independence and a rich, free life is surprisingly straightforward. J.L. Collins distills investing to 3 core principles: spend less than you earn, invest the surplus, and avoid debt. He champions the power of low-cost, broad-based index funds, particularly Vanguard's Total Stock Market Index Fund, VTSAX, as the most effective wealth-building tool, consistently outperforming actively managed funds and individual stock picking. Collins emphasizes developing mental toughness to ride out inevitable market volatility, viewing downturns as buying opportunities. He advocates for simple asset allocation strategies tailored to life stages, accumulation versus preservation, and highlights the importance of FU money for true freedom. The book demystifies investing, empowering readers to take control of their financial destiny without relying on expensive advisors or complex strategies.
If you enjoyed the content, please consider supporting the author. Thanks for watching, and if you like this video, subscribe. Now, let's go to the next video.